Well, hello everyone. My name is Elliot Gu. I'm co-founder of Capitalist Times Investment Research and Energy and Income Advisor. And today I want to talk a little bit about oil. And specifically, I want to talk a little bit about what the smart money is doing in oil and how we can monitor what the smart money is doing in the oil market. So what I'm going to talk about today is a report. It's released weekly, every Friday, by the Commodity Futures Trading Commission, the CFTC, cftc.gov. It's available for all to see. And it's called the Commitment of Traders Report. And there are a lot of different categories within the Commitment of Traders Report, but basically what it shows us is the net position, the long position, the short position, and the net position for in the futures market, all sorts of futures from various types of trader. Now, there are two broad categories of trader in the Commitment of Traders Report. You have the commercial trader and the non-commercial trader. The commercial trader is what I want to talk about today. Now, the commercial trader, the CFTC defines as a company primarily engaged in a business which requires them to hedge their exposure to the commodity. So in the case of oil, the West Texas Intermediate crude oil contract traded on NYMEX, these hedgers could be a producer. So a company that produces oil might want to hedge its position in the oil market by selling oil futures or buying put options on oil. And so the idea there, of course, is that if you want to lock in a price for oil that you plan to produce, say, in December of 2025, you could buy a put option, a December 2025 oil put option, and any price below the strike price of that put, you could actually benefit from it. Or you could sell a crude oil futures or purchase a crude oil swap from a major bank who would then use the futures market to hedge their exposure and lock in those prices. So when a producer wants to hedge their position in oil, they're going to short oil or they're going to buy a put option on the oil futures. Other hedgers might be, for example, an airline company. So a company that might have exposure on the cost side to oil, they might want to buy oil contracts. So they might want to go long oil, say at current prices for oil, below $60 a barrel, because they think that longer term oil prices are going to be higher, their fuel costs are going to be higher, and it's a way they can reduce their exposure there. In the oil market, the largest category of commercial trader out there is going to be your producers. These companies are active, going out and hedging their exposure to oil contracts. And so they're mainly going to be short oil because they're locking in a high price of oil. They're naturally long oil because they produce oil. And so they're offsetting that by shorting oil futures to offset some of their exposure to potentially lower oil prices. So let me show you a chart of the net commercial commitments of the commercial traders in the WTI market going back to 2014. So I took this back quite a long way. And this is back to the beginning of 2014, so a period of over 10 years. And this shows the net position. So this is gross longs less gross shorts. Now, as I said, the largest category of commercial trader are going to be your producers, and they're generally going to be either shorting oil or buying oil put options. So the net position here is always short. So in this case, you can see, and this is in thousands of contracts. So for example, right at the beginning of my chart, the hard left-hand side, the hard left-hand margin, you'll see that commercial traders were net short a little less than 400,000 contracts of oil. Each contract represents 1,000 barrels, so that's 400 million barrels of oil, okay? And you can see how it's evolved over time. So the higher you are up on this chart, that suggests that the less hedging activity producers are taking on. And it could also indicate that companies like airlines are buying oil futures to hedge their exposure to potentially higher oil prices in future. They're buying oil futures because if oil prices go up, their costs are going to go up. But net, you're going to see a smaller net short position means that producers are not as actively hedging against lower oil prices. You could say that producers are bullish oil, or at least they're not particularly bearish oil. Now, what I've done on this chart, and I will throw this up several times as we go through some of these different historical periods. I'm just going to pick out a few historical periods on this chart and talk about what happened and how I use this indicator. But I've labeled some of them on this chart, and you can see it there. And again, I will throw it up several times over the course of the next few minutes. But I did want to draw your attention to that red arrow, or that red circle on the right-hand side of my chart. Okay, that is actually the net commitments from April 8th, 2025. So about a month ago, a little less than a month ago. So this is very recent data. And this is actually the smallest net short position from commercial traders in the West Texas Intermediate crude oil market in the history of this chart, going back more than 10 years. We've never seen a smaller net short position from commercial traders. So you could say that on April 8th of 2025, commercial traders were the most bullish they've been on oil, or at least the least willing to hedge their exposure to oil prices going back more than 10 years' time. And this is through several cycles, right? We've had bull markets in oil since 2014, nasty bear markets, and everything in between. So I want to talk about how I use this data. What I'm looking for, now the hedgers, first of all, think about it, the hedgers are going to know more about the oil supply and demand balance than you and I do. These are companies actually in the oil business. So they're seeing what they're producing, they're seeing their cost structure, they're seeing what their peers in a play like the Permian Basin are producing, and what they think is likely in terms of drilling activity from their peers. They also can see more firsthand what demand conditions look like, what export conditions look like. They have a firsthand knowledge of business conditions in the oil market. So what they're doing tells you a lot about what they think oil prices are likely to do. So what I tend to look for is a situation where oil prices are strong, right? And producers are increasing their short position. So this net commitments line would be falling very aggressively to a relatively low level. Now what that tells me is that hedgers, producers, are taking advantage of the rise in crude oil prices to sell more aggressively, sell oil aggressively. So they think those oil prices, right, when the price of oil is rising, they think those rising oil prices look attractive and they want to lock in that price of oil. That is bearish oil, because what it means is that the hedgers don't believe that those high prices are sustainable. Flip side of the equation, oil prices are weak and you have hedgers reducing their hedging or not hedging very aggressively. And that net commitments line is near the top range of my chart. What that means is that hedgers don't believe that oil prices are going to remain low for long, and they certainly don't want to lock in current oil prices over the long haul because they think prices are likely to rise in future. Doesn't always work, but those are the two patterns I look for, and it works in my experience more often than not. So let's look at a few of these historical examples so you can see exactly what I'm looking for, both highs and lows, and also what I see going on in the market right now. So let's start with that first point that I've marked on my chart from June 2014, specifically June 24th, 2014. Now, this is a chart of oil from that era. I took it back to beginning of 2013 all the way up to the end of 2014. Now, this is a long period where crude oil prices were basically in a trading range. From 2010, 2011, all the way up through late 2014, oil prices range from sort of $85, $90 a barrel, I'm talking WTI, West Texas Intermediate here, all the way up to sort of 110, 115 at the top end of the range. So they were in a trading range over this entire period. But as you can see on this chart, in the first half or so of 2014, oil prices were actually relatively strong. They were rising from that low 90s, sort of the bottom of that trading range, and had gotten up to around $107 a barrel in late June of 2014. But what were the commercial oil producers doing? What were the commercial traders in the oil market doing? They were actually using that rise in prices in the first half of 2014 to hedge very aggressively. So as you can see on the chart, and I'll throw it up here again, in June 24th, 2014, they were short more than 500,000 contracts. That's 500 million barrels of oil, which was a relatively large amount of hedging activity. they were taking advantage of that rise in oil prices to bet on falling oil prices or to lock in those attractive high oil prices right at the top of that trading range. That was a signal of potential trouble ahead. Sure enough, what did we see that year? As you can see on my chart, we saw oil prices plummet from over $107 a barrel in late June, all the way down to $53 and change by the end of 2014. Okay, so that signal really worked. And ultimately, oil prices got down into the mid-20s a barrel by early 2016, which I will show you here in a minute. So let's flip back over and look at that net long commitments and talk about the second point on my chart. Now, this is a high point on my chart, indicating relatively light hedging from U.S. oil producers. And that was on January 12th of 2016. Now, mid-January of 2016, the net commercial commitments were a little over 200,000 barrels, 200,000 contracts, or 200 million barrels of oil. Remember, I showed you in 2014, they were short over 500 million barrels of oil, now just a little over 200 million barrels of oil. So a big shift there from commercial commitments. Now let's look, very important, let's look at what oil prices were doing at this time. As I alluded to earlier, oil prices were actually very weak in early 2016. So oil had plummeted from over $107 a barrel in the summer of 2014 to the mid to upper 40s in the summer of 2015. But by early 2016, oil prices were down around $30 a barrel. And they got down into the mid-20s a barrel. So I've labeled that date on the chart. That's January 12, 2016. At that time, oil prices were trading around $30, $31 a barrel. Now, this didn't nail it exactly, but you had weak oil prices and hedgers being less aggressive hedging. So in other words, hedgers were not willing to lock in those $30, $35 a barrel oil prices. They were reduce their hedging activity. They felt that oil prices were likely to rise, more likely to rise than fall. They were bullish oil at that time, and they were right? You can see here, didn't nail the exact low. We got down to the mid-20s, but by the end of 2016, we were all the way up in the mid-50s per barrel of West Texas Intermediate. So that brings me to the next set of data on my charts. Let's go ahead and put that chart up here. And you can see, the commercial commitments line. We can see in February 21st, 2017, commercial commitments to oil down short more than 600,000 contracts, 600 million barrels of oil. What were oil prices doing in February 2017? Well, let's look at the chart of oil once again so you can see what's going on. February 21st, 2017, oil prices were up in the mid-50s a barrel. They had been generally rising throughout 2016, and they were near the high of that range in the mid-50s. The highs that we hadn't seen in a long time, since early 2015. And hedgers were aggressively hedging. They were taking advantage of those prices in the mid-50s to sell more oil, to lock in those mid-50s a barrel pricing. Now, what happened to oil? Sure enough, between late February of 2017, when this signal tripped, and mid-June of 2017, we went from the mid-50s to the low 40s a barrel. So maybe not as big of a move, but certainly a general downward bias in oil prices at that time. Okay, now let's look at a situation where this signal didn't work. Now, I promised to show you that, and I think it's important to just remind everyone out there, there's no such thing as a perfect technical or fundamental indicator. This is kind of a combination of the two, if you will. But there's no such thing as a perfect indicator. They will be wrong, no matter what you're looking at. But this is right more often than it's wrong, and this is an exception that kind of proves the rule. So look at this chart. Again, the commitments, the net commitments here. You can see that in January 30th of 2018, hedgers were short more than 800,000 contracts of oil. This is a record short position on this chart. They were betting aggressively on lower oil prices. Now, at the same time, that little pattern I look for checked out. Oil prices had been strong up through that moment. As you can see on this slide, oil prices had ramped up from $45 a barrel in the summer of 2017, all the way up to $65, $66 a barrel by early 2018. and hedgers were aggressively taking advantage of those higher prices, those rising prices, to sell oil, that's usually a signal that potentially they see weakness ahead, or at least they're happy to lock in that mid $60 a barrel pricing for oil for the long haul. That's why they're selling oil futures so aggressively. And they were wrong, right? Oil prices did pull back a little bit into the high 50s, as you can see here, 59, $60 a barrel, but then they ramped all the way up to $76.41 by the early autumn of 2018. Now you could say they were eventually right. Oil prices ultimately plummeted in late 2018 amid a broader market sell-off and just a lot of turmoil in financial markets, all the way back down to the low to mid 40s a barrel by the end of that year. However, I'd say they got this wrong. It was a little early, or very early, which in financial markets, as you know, is the same thing as being wrong. Again, though, this is an example when it didn't work, but these are relatively rare. Most of the time, this signal is pretty good. So let's move on from that to the current situation. And I'm actually going to show you on this next slide two different signals. But let's start by looking at the net commitments chart one more time. Again, this is the whole chart, but I want to draw your attention to two dates sort of towards the right-hand side of this chart. The first is October 3rd, 2023. So early October of 2023, when hedgers were being very aggressive. They were selling oil aggressively from the summer of 2023 up until early October of 2023. Then I want to draw your attention once again to that April 8th, 2025 moment that I mentioned a little while ago, where hedgers had the smallest net position, short position in oil that they've had in this entirety of this more than 10-year long chart. And you do have to remember that this data is released with a little bit of a lag. Every Friday, the CFTC releases data as of the prior Tuesday. So, for example, the most recent data we have is the data from Tuesday, April 29th. It was released Friday, May 2nd. On Friday, May 9th, this coming Friday, we'll get data as of Tuesday, May 6th, market close. So there's a little bit of a lag, but April 8th, we do know that the hedgers were net short the fewest amount of contracts, the smallest net short position in the history of this chart. So let's look at how oil is traded around these two dates, early October of 2023 and early April of 2025. So first up, let's look at that early October of 2023 date. Going into that moment, right, the oil price of oil had been very strong. And so early October of 2023, oil prices were trading up in the high 80s, low 90s a barrel, and hedgers were aggressively hedging. They were selling oil into that rally. So again, this was a signal that the oil market was potentially, they saw some downside risk for oil. They didn't believe prices up in the high 80s, low 90s were sustainable in late 2023, and they were very right, as you can see on this chart. By December of 2023, oil prices had plunged back down to the high 60s a barrel, back down where they were that prior summer. An additional aspect of that was that you might remember in early October 2023 was when we saw those terrorist attacks in Israel. And this was sort of a geopolitical event that caused another spike in oil. And you can see that, a ramp up in oil from the low 80s in early October 2023 up to the high 80s again in the middle of October following that terrorist attack. Now, longtime readers of my services know that I'm generally inclined to tell people that geopolitical events are something you want to fade. If the oil market spikes on a geopolitical headline, usually you want to sell oil into that rally. And if it sells off in response to a geopolitical event, which is less common, if there's a spike lower, it's an opportunity to buy oil. Because geopolitical events, usually the markets overreact to the news and then sort of rationalize over time. And that's exactly what we saw here. You kind of got a second opportunity to short oil on the signal in the middle of October, and then oil prices did ultimately decline down into the high 60s by December of that same year. Okay, now let's move forward to the current situation. Now in early April of 2025, this year, oil prices had been very weak. They'd fallen from almost $80 a barrel at one point in January this year, down under $60 a barrel, the lowest prices we've seen in some time now in early April of 2025. But hedgers were reacting in exactly the opposite fashion to what they were doing in 2023. When oil prices were weak, they were becoming more bullish on oil. Their net short position in oil was the smallest we've seen in over 10 years. So what that tells me is that hedgers do not see current oil prices in the high 50s as attractive longer term. Therefore, they don't want a large hedge position. It also suggests to me that they see the potential to hedge or sell their oil at much higher prices in the future than the current price point of oil. Now, this is not the only indicator I look at, obviously. It is not infallible. I think I've said that 4 or 5 times on this short video. But when combined with other aspects out there, I do think this paints a pretty bullish picture for oil, that with the news headlines, the media being so negative on oil, there actually are a lot of positive fundamental factors that currently are being swept under the rug. And I think that's what the hedgers are responding to with this very small net short position on a historical basis. You know, one thing is that when oil prices are down where they are today, you're going to see U.S. shale production fall over time. U.S. shale production is already falling. It's already well off its highs. And I think the longer oil prices stay down where they are in the high 50s or low 60s, the faster you're going to see U.S. oil production roll over. Now, a lot of people say to me, yeah, well, but the U.S. shale producers can break even at, in many cases, $45 or $50 a barrel, or even lower in some cases. So won't they keep drilling? No. Got to remember, a lot of these shale producers have a limited number of drilling spots on their acreage. Why are they going to want to burn through those drilling locations, those prime drilling locations, with oil at $58 a barrel if they think that maybe in 6 or 12 months' time they could burn through those drilling locations at $75 or $80 or $90 a barrel oil or even higher? So what this is telling us, especially in combination with the commercial commitments data I showed you, is that U.S. oil production is likely to roll over the longer prices stay down where they are. The other thing is, I think a lot of people misunderstand OPEC. OPEC recently said that what caused this last leg lower in oil prices was that they're going to be accelerating some of their planned return of production. They're going to be increasing supply into this oversupplied oil market. But the fact is that what OPEC says and what's actually on the tin are two very different things, right? The only countries in OPEC that actually have spare capacity are Saudi Arabia, United Arab Emirates, and maybe a couple of others, but those are the two big ones. So a lot of this planned production increase is really just OPEC recognizing what already is, which is that a lot of its members are already outproducing their quota. It doesn't necessarily mean that, that global oil production is going to go up from OPEC 400,000+ barrels a day in the month of June. That's the headline. That's not the reality. The other thing is on the demand side. China is stimulating their economy. I believe they may have to do more stimulus the longer there's this trade conflict going on between China and the United States. More stimulus from China equals more oil demand. So I think there are a lot of positives out there which are being ignored right now. And I think the commercial traders have proven that they agree with me. They're certainly not willing to hedge oil production, sell oil, buy puts at current low prices. So I think we're very close to a low for oil here in the high 50s. I think you're more likely to see $70 plus later on this year than prices down in the low 50s or sub 50. So if you'd like to learn more about our current outlook for oil, as well as some of the stocks that we're currently recommending in Energy and Income Advisor to benefit from this, what I think is going to be a major bottom in oil going forward, then you can click the button below this video, the link I'll leave down below this video, which actually is a risk-free trial offer to Energy and Income Advisor that we're offering now for a limited time. In addition, of course, one of the things I've been trying to talk about in these videos is some of the other areas within energy that are already performing really well right now. Recently, I put up a video about natural gas. I'll go ahead and link that too down below, talking about how I believe the natural gas market is actually a bigger opportunity this year. fact, my colleague Roger Conrad and I have been kind of pounding the table on natural gas producers, some of the natural gas midstream names now for 9+ months, and many of them are up quite a bit this year, despite the weakness we've seen in oil and many oil-levered energy stocks. So that's another area to look at. Again, you can check it all out, see all of the recommendations with that 60-day risk-free trial to Energy and Income Advisor. But overall, I hope you found this video useful. I hope that commercial commitment of traders report data is something that you can add to your toolbox and find useful over time. I certainly have. Again, my name is Elliot Gu. Thanks for listening. I'll be back shortly with another one of these videos, and I'll talk to you soon.